Hello, everyone, and welcome for the final Fratarcangeli Friday market update of the year. I hope everyone is getting prepared for the holidays. Happy Hanukkah to everyone, and happy holidays and Merry Christmas to all of you that are preparing. As we look at the markets that have started to be more volatile on the downside starting in November, let's just take a step back and look at the data. How quickly we forget that the Fed has recently lowered rates for the third time for this current year of 2025. And what's even more interesting is that they're starting to inject more liquidity into the market, buying more treasuries. Let me remind you, since 2025, they've been tightening up the money supply, which is basically taking liquidity out of the system. And then as of December this year, just recently, they're starting to buy some more treasuries and create more liquidity in the marketplace. So lower interest rates and moving more liquidity into the system is a good sign for the economy and how that can affect the coming months and quarters with earnings and economic activity. We're also watching the data that we're starting to get back in tune with, and hopefully this will be very helpful for us to navigate the next directional move by the Fed, as well as how we should operate with our businesses. We have 7 million job openings, which is a 5-month high. That bodes well for the Fed to continue to consider lowering rates. Also, more and more people are sitting tight in their jobs. The number of people leaving their positions is down to 1.8%. That's a considerable low over the averages. What we also saw recently in the November job report was 64,000 jobs available. And that supports lower interest rates, and it certainly supports the fact that the Fed lowered interest rates in December. These bode well for an economy going forward. An additional factor that we're watching right now is the fourth quarter GDP has been reduced by 1%, but also what's happened is they moved that 1% to the first quarter of 26. So we're looking for a 3.5% expansion and gross domestic productivity here domestically to 3.5%, which is a very robust number, which could be a great start to next year relative to economic activity. Also being monitored is inflation. We're seeing inflation tame. We're looking at a 2.7% inflation rate for the current year. But what's also compelling is we're calling on a 1.2% inflation rate for 2026. Let me remind you where we were a few years ago at 9, 8, 7% inflation. So we're coming down dramatically, well below the target that we've heard the Fed talk about for years of below 2%. So these are positive directional factors that bode well for us out there spending money and trying to make sure we make ends meet, and also companies being able to meet expectations. So these are all positives relative to the outlook for the 2026 year and with interest rates and the Fed's next move. In addition to that, we're looking at earnings growth. Here we are, 2025 fourth quarter earnings upon us. We're going to be looking at those data points next year, but we're anticipating a 12.1% year-over-year earnings growth. When I talked to you over the last few months, we were targeting 11%, and then it was 11.5%. And recently, we've seen the data come in at 12.1%. That is going to be the third consecutive year of double-digit earnings growth, and the sixth consecutive year will be next year's earnings growth year over year. So we're seeing very robust earnings to the not only history, but as well to the future. These are very good numbers to keep our eyes on as we enter into 2026. The other factor that, of course, we're all being polarized with watching is the fact that the market has been down really since the beginning of November. Historically, September is the more volatile month that usually spills over to October. That didn't take place this year. Let me remind you, we had a very volatile year this year. We started out the year pretty flat, and then we took a minor move up, and then we had the market pull back on the news of tariffs, where we were down between 13 and 17% through April 7th before the market started to really take off. So it was a little bit of a unique start to the year, and the fact that we didn't have a pullback in September could have been a major reason for that. But the reality of the situation, we're back to volatile times. I will tell you, having sat at this post since the mid-90s and watching the market even before then, I've seen the market go straight up without looking back and retrenching. I can tell you that's unhealthy. I've used the example as if you're building a skyscraper, or if you can visualize building a skyscraper. If you don't test the support on each floor before you go and build the next floor, what could happen is you will collapse. We dealt with that in the early 2000s when the market had gotten too elevated and we were in a bubble. The fact that we're retesting earlier this year in April, some of the support levels. And now again, in some of the high valuated stocks being elevated in the tech sector, testing some of those support levels, I will tell you, will go a long way to allow those companies to have strong, healthy upside in the future. So I just believe this is part of the path and part of the ultimate journey of long-term investing and creating a healthy environment in the marketplace, having dealt with bubbles in the past. I hear a lot of people talking about this is another bubble. This is another 2008. I don't see those factors. I see markets that are continuing to test new highs and retest previous lows before it goes higher. And I'm seeing earnings growth support the fact that the market can go higher. I think there's multiple factors out there that we're watching very closely that I'll come back and talk to you about every couple of weeks, not to mention in person, that align towards the fact that this market isn't done yet. We have more upside, but we have to keep in mind what our objectives are individually. How much cash do we need on hand to protect us from the unknown as well as the known expenses that we have? Also simultaneously making sure we identify the money we are highly confident we're not going to need for many years to come, and make sure that money's combating inflation and growing for us and invested accordingly to our time horizon and our objectives. These are all the factors that we take into consideration as we guide and counsel you here at Fratarcangeli Wealth Management, and make sure that we monitor the data along the path. This concludes this week's Friday market update and what is happening in the world, what is happening in economic data, and what we anticipate for 2026. I just want to take this moment to thank you all for the trust that you've given my team and I at Fratarcangeli Wealth Management that just crossed over our 30th year in business, which was on December 18th, 1995. What a ride it's been. It's something that I'm so grateful and so blessed to have the opportunity to still be here and have the opportunity to guide and counsel you. And I just thank you all, and I wish you all the best this holiday season. And I'll tell you this, I think 2026 will be another great year for us that we'll plan for. We'll double check our work, and we'll continue to deliver guidance and counsel that allow us all to meet our objectives. I wish you all the best, and I'll see you soon. Bye for now.